A very good morning to everybody. At the outset, we would first like to thank Annamalai Alumni Business Network Meet to give us this opportunity to present in front of all of you. Thank you for an amazing introduction, Gopi sir. We would like to again, me and my partner Vineet, we would be taking the segment in two different halves. I would first start off with the benefits under Income Tax Act. Before I get into that, I would like to present the kind of structures which are available in India. So if you see in terms of forms of organization, Indian organizations can be broadly divided into three types: sole proprietorship, partnership, and companies. Sole proprietorship being the simplest form of organization. It is an organization where the business and proprietor are the same and the returns are filed together. There is unlimited liability for the proprietor and it's ideally suitable for small businesses. Then comes partnership. Partnership are again of two types. There is ordinary partnership and there is limited liability partnership, LLP. Ordinary partnership entails unlimited liability of the partners, but whereas limited liability partnership, the liability of the partners is limited only to the extent of their contribution. The other difference between the two being the second one has LLP has higher compliance and registration with MCA is compulsory. The third and the most organized forms are the companies. Companies are again divided into two types: public limited and private limited companies. Where public limited companies are allowed to accept funds from the public and are suitable for larger businesses, private limited companies are not allowed to accept public funding. They are suitable for privately operated businesses looking to go corporate. There is another category called 1% companies, which is more suited for startups where a single person wants to establish a company and go corporate. Next. Um, there are a few hidden gems under the Income Tax Act, which many of you may be aware or may not be aware, but we thought it could help us if we could shed some light on the same. Given demonetization and GST, our economy was facing a sort of a slowdown. And in this backdrop, the government wanted to introduce game-changing tax measures so as to boost growth and growth in the form of corporate growth. And with this idea, the finance minister on 20th September 2019 introduced two sections in the Income Tax Act, Section 115 BAA and Section 115 BAB. These sections now put Indian corporates in one of the most competitive tax rates across the globe. This will not just help the companies to come and invest in India, but it would also help Make in India by attracting manufacturing investments. We'll see how. So the first section is 115 BAA. This section is available to all existing companies. Any company which is in existence can opt for this section. The tax rate for such companies will be only 22%. With a surcharge of 10% and cess of 4%, the effective tax rates will come to 25.17%. Now, for example, you are running a proprietorship in the highest tax slab, or if you are an LLP, you must be shedding tax if you are a proprietorship to between 30% to, let's say, even up to 42% with all the surcharges and super taxpayers. And in case of LLP at 31.2%. But if you go corporate, companies face an effective tax rate of 25.17% only. But of course, there are certain terms and conditions attached to this section. There are a lot of deductions and exemptions given under Income Tax Act, such as to SEZ units for people who are investing in backward areas, or tea, coffee, rubber allowance, site restoration funds, etc. All these deductions will now not be allowed to be taken by the companies who opt for this 25% tax rate. Most of us are MSMEs here, and it's highly unlikely that we are into these sorts of niche areas. So if we see from that angle, apart from accelerated depreciation, which is additional depreciation over and above the regular depreciation, all the other benefits even we generally do not avail. So in that scenario, migrating from a proprietorship or an LLP to a private limited company can help us save around 7% in taxes in case of LLPs. And if you're a proprietorship who is under the super rich category, you can save up to 17% in taxes by going corporate. You might argue that there is some taxation on dividends, but since for running business, most of the profits are again flowed back into the business, that extra saving of 7% or up to 17% will be a huge saving. One of the biggest tax reforms in terms of manufacturing is Section 115 BAB. This section was introduced and has placed India in one of the most competitive tax rates across the globe. What does this section say? If you are a newly set up manufacturing company in the form of a private limited company, you will enjoy a tax rate of only 15%. Yes, income tax of only 15%. With a surcharge and cess of 10 plus 4, the effective rate comes to around 17.17%. Now, why was this brought into? This was brought to give a boost to manufacturing. But of course, with this concessional rate of tax, there comes some terms and conditions. The company should be set up after 1st of October 2019. That means it should be a freshly incorporated company after 1st October 2019. And the manufacturing has to commence before 31st of March 2023. Now, this company cannot be formed as a part of hive off of another company, or it cannot be an amalgamation of two companies. It has to be a new entity. It cannot use second-hand plant and machinery up to 20%, more than 20%. So let's say you are setting up a new manufacturing company here. You have to buy new machinery up to the 80% of the total capitalization or asset value. Now, what is this new machinery? This new machinery has been defined as any machinery which is used for the first time in India. That means if you are procuring your machineries for your manufacturing unit from India, it has to be brand new. But in case of imports, second-hand machinery is okay in that 80% criteria. So bottom line, 80% of the machinery has to be such machinery which is used in India for the first time, and 20% can be second-hand of any category. Just to sum up these two sections, in the first section, there is no restriction on the nature of business, but in the second section, you have to be a manufacturing entity for sure. In the first section, any company existing, already existing can opt for it. In the second option, the entity should be set up after 1st October 2019. In the first section, the tax rate is 22%. In the second section, tax rate is only 15%. On, let's say this manufacturing company may have some other income like FD interest to empanel with any vendor, or some EB deposit they would have given. On such income, which is non-manufacturing income, on that also they will be charged only at 22%. In case the depreciated assets is later sold, that capital gains will attract only 22% of tax. Surcharge is the same for both. In the first option, there is no condition that it cannot be split up or restructured entity. But if you are opting for the new manufacturing section, it cannot be a restructured entity. This option has to be exercised and before filing your income tax return in the first case. But in the second case, before you file your first income tax return itself, you have to opt for this particular manufacturing setup. So quickly to summarize, if you are a proprietor or a LLP and you are planning to buy a new machinery now, instead of buying in your existing organization, you can set up a new manufacturing private limited company and enjoy 15% tax on whatever you produce and sell it, which is a huge tax saving. Next, one of the biggest catchphrases of the decade has been Startup India. Startup India, startup as a thing has made tremendous change in the world in terms of businesses and ease of living. So if you would have seen, there are numerous benefits that were announced. We have heard that startups are getting this benefit, that benefit, but it is not common for people to understand what actually are these benefits in terms of taxation, in terms of other benefits. So our aim here is to simplify that for you. Most of us are business owners here, or we manage businesses. Tomorrow an income tax officer comes and tells you, sir, for the next 3 years, please don't pay me any income tax. How will you guys feel? Whatever profit you earn, please don't pay me income tax. You would feel great, right? This benefit is provided to recognize startups. Yes. 3 years, no tax. 3 consecutive years. I'll get into what are the criteria for this. Who is a startup? A startup is a DPIIT recognized startup. DPIIT is a Department of Industrial and Industry Promotion and Internal Trade who has to approve your startup. It can be only a private limited company or an LLP. The startup should be incorporated on or after 1st April 2016. And the startup should be engaged in something innovative, development or improvement of products, or making any scalable business model which can generate huge employment. From the incorporation in the next 10 years, any 3 consecutive years, you will enjoy zero taxes on the profits you earn. But the turnover has to be less than 100 crores. The other benefit is angel tax exemption. Normally, if you are going to invest in any company, you can invest at only the fair value of that company. If you find potential in that private limited company and you want to give a higher premium to them, the government will come back and say on that premium, we will tax the investor. This discourages investments. So for startups, there is an exemption in angel tax, where if you are a DPIIT recognized startup and with the equity infusion, the paid up capital and premium is less than 25 crores, then even if the investors, they invest at a higher value than your actual fair market value, there won't be any tax implications. The other benefits that are provided to recognized startups are fast tracking of patent applications and in 80% rebate in patent fees, which brings down the cost from 8,000 rupees to 1,600 rupees. The government of India has also given relaxation for startups who empanel for their government procurement. In terms of prior turnover, prior experience, earnest money deposits, huge benefits are given to startups. Then there are a lot of access to government and learning programs. There are access to repository of sample templates for legal HR documents, investor decks, deeds. In case by chance a startup fails also, the exit and winding up with MCA is also easier. To sum it up, you are having a path-breaking or innovative idea. Instead of making a regular partnership, proprietorship, you come and you register with Startup India. You can not only save in taxes, it will boost you in terms of government procurement. You can get angel tax exemption and you will be on the path of high growth. And it is an excellent tax saving opportunity also. Now, I would like to hand over for the next section to Vineet.
Hello, am I audible?
Yes, you are.
Yeah. So I'll be covering compliance under GST. Yeah. So GST, as we know, is right now the most dynamic law. Most people undergo, the challenges that are faced. GST is the one that is the law in which they are facing most difficulties. So let's look at what are the compliance that need to be done. So GST, when it was brought in, the USP, what GST had was one nation, one tax. And by that means everyone is taxed under one single law. And what that specifically brought was seamless input tax credit. Now, what is seamless input tax credit? In a simple example, let's say I'm, in trading with this laptop. Now I decide to buy the laptop for 1 lakh and I pay 10,000 GST to my vendor. And when I sell the laptop to my customer for 2 lakhs, let's assume, and I have to pay 20,000 GST to the government, I can take credit of this 10,000 which I paid to my vendor and net remit 10,000 to the government, right? So given this backdrop, this is what GST wants to implement. It wants to implement seamless input tax credit. So now for this, there are essentially 3 returns that need to be filed: GSTR 1, 3B, and 9. So quickly giving you a brief on this, GSTR 1 is where I declare my revenue and I declare how much tax I need to pay. In this case, the 2 lakhs that I have sold to my customer and the 20,000 that I need to remit to the government, I have to declare in GSTR 1 by the 11th of the next month. GSTR 3B is where I effectively discharge my liability. So in this case, the 20,000 minus 10,000, which I had mentioned, my net 10,000 which I have to pay to the government, I have to discharge under GSTR 3B. And GSTR 9 is the annual return, wherein the entire year's sale, output tax, input tax credit, any amendments are made, everything is reconciled over there. So given this backdrop, I've taken an example of a company which has a head office in Tamil Nadu and 3 branch offices in Kerala and Karnataka. So essentially, even though it's one PAN number, they have to take 3 different GST numbers. Now, given this scenario, the enterprise eventually will have to file 75 returns to stay compliant. That is a lot of returns, and this is the indication that the government is very serious about these compliances. We'll dive into this a little more. So what we've always known is that customer is king, but what our honorable finance minister is trying to tell us is that compliance is the next king. So if we do not remain compliant, there will be a lot of repercussions. There will be a lot of burden that will be put on us. So as auditors, these are the common misconception and mistakes we identify with business owners. Not only business owners, because business owners are not accounting professionals who have read someone who has worked, has X amount of years of experience. Even we have seen there, in those cases, we have seen these misconceptions. So we'll just go through them one by one. The first one is understanding the limits for taking registration under GST. So a simple scenario, we notice this most common in people in their individual returns, wherein let's assume that you have 18 lakhs of interest income, right? 18 lakhs of interest income. Interest income has no GST on it. You have 3 lakhs of rental income, which is commercial. You've given it to a shop, an office, or go down, and you're getting commercial rent on that. It's a common misconception that I do not have to pay GST. My business is paying GST. I'm in the business where I'm trading with laptops or something, and that business I'm GST. In my personal law says aggregate turnover. Aggregate turnover includes exempt income, taxable income, nil rated income, everything. So whatever is my income that is there, I have two limits. One is 20 lakhs for service providers and 40 lakhs for traders of goods. So if I cross this threshold, I have to pay tax. But on what income? Only on the commercial income. My interest income will continue to be tax free. I do not need to pay tax on that, but I have to go through all the compliances which I had mentioned over here. That means I need to file GSTR 1 and 3B every month, even if it is nil. Nil return I have to file every month, and to the extent of only my taxable turnover, I need to pay GST. The next common misconception is GSTR 3B is more important than GSTR 1, because 3B is where I remit my liability. GSTR 1 is a mere declaration of my liability. So it does not have any serious consequence, is what a lot of accounts representatives believe, a lot of business owners believe. But this is definitely not true, especially given the recent amendments in the union budget, wherein in the previous scenario where I had purchased this laptop from my vendor, if he does not file his GSTR 1, the portal which has a GSTR 2B auto-populates whoever has filed their their returns against my GST number. So how do I take this 10,000? I can always try to tell the government that this is not 10,000, it's 20,000. How does the government know that this 10,000 which I have bought from this vendor is an actual credit that I have? Only if he remits his GSTR, he files his GSTR 1 on time, uploads it, and then it reflects in my GSTR 2B. If this is not done, you cannot claim ITC. So in that scenario, I would have had to pay 20,000 to the government separately, and then claim this 10,000 whenever this vendor files the return. In that month, if I don't have any output liability, I have not made any sale, that 10,000 will be sitting as is and can be used whenever I have a next sale. Now, this might not sound too critical, but this is a very simple example where I have ended up paying 30,000 GST instead of 20. Now, given what turnovers businesses have, there can be a significant working capital crunch. So then, so definitely the concept of GSTR 3B is more important than GSTR 1 is wrong. The next point, input tax credit can be claimed as soon as I receive my invoice. This is linked to my previous point. I might have received the invoice, but if my vendor does not file his GSTR 1 on time, I will not be able to allow. I cannot take that credit. So if it is highly advised that you go back to your accounting teams, go back to your people who look into GST and ask them, are we tracing this? Are we tracing people who are not filing GSTR1? If they have not filed GSTR1 for the last 2-3 months, and there's a lot of credit that you need to take, which is accumulating, you need to take action immediately in those cases. And the next concept is, as long as I give my GST number, all inputs are available. This is a classic case where you go into a passenger car showroom and you decide to buy a car, and you tell him that I want to buy it in my company's name. I give you my GST number. Can I take credit? To sell you the car, he will say yes. He will say, yes, sir, I will, don't worry, you give me a GST number, I'll upload the data. It will also reflect in your 2B. So let's say you bought a car and there's 3 lakhs worth of GST in that, it will reflect in your portal. You will be tempted to claim it. He would have told you, sir, you can go ahead and claim it, but you cannot claim this because it is specifically blocked under the Act. There are a lot of transactions which are specifically blocked under GST, saying you cannot claim credit on these transactions. So it is very important that our people looking into GST, people handling day-to-day GST are aware of these transactions and do not take incorrect input tax credit, because essentially what will happen is all of this will get identified maybe 18 months later when there's an audit to be done, and you will have to reverse this and pay interest on 24% for the period. So if there's 1 lakh of GST that you've wrongly claimed, you'll end up after 18 months paying 24,000 plus 6 months. So that much of interest over and above because of this wrong claim that is made. And additional place of business. Now, in the previous scenario, I gave you 3 examples of Tamil Nadu, Kerala, Karnataka. Let's assume an example that within Tamil Nadu, I have 3 branches, Chennai, Madurai, Salem. Now, Madurai and Salem need to be added as an additional place of business in the GST portal. Be it a go down, be it a shop, be it a retail outlet, be it anything. You need to add it and declare it. We had a scenario wherein a person came to us. He had already added he had already taken up a warehouse on rent as an additional place. He had not declared it in the portal. He had started making sales from there. The officer, while checking these goods on transit, noticed that the address is another address, but in the bill he has mentioned the new warehouse which he has taken. So he has not registered this. He filed a case that the assessee is trying to evade tax and is and a case of fraud. Now we had to go and argue against this, that it was a mere administrative lapse. The assessee paid his rent paid through official means, paid had a rental agreement, had paid advance. The liability from those from that place was also declared and paid to the government. There was no reason to evade tax, but it was a mere lapse in performance. And especially after he was notified that he had not added this, he had gone ahead and added it immediately. All of these points were presented, but still the officer was of the view that no, there is an evasion of tax, and he put 100% penalty. So the case is still hearing to come. So the next portion would be non-filing of LUT, letter of undertaking. Now, letter of undertaking is a mechanism by which all people who are exporting, be it goods or services, need to file this letter of undertaking. Thereby, the alternate procedure would be I would pay IGST on my export and then claim refund of that IGST. Now, to give you a working capital saving, they are saying file the letter of undertaking wherein you say that you are exporting the goods and you will receive it in foreign currency. And once you file this, you can happily go ahead and export without paying this IGST amount and having this working capital block. But if let's assume that you have paid this IGST amount, if you have not filed LUT, refund immediately. Again, we have to go ahead and argue, stating that this was a mere procedural lapse. It does not, avoid me the right which I'm entitled to get this refund. But this will again cause working capital blocks. So if anyone is exporting, be it service or goods, please go back to your teams and ask them, are we filing an LUT? Have we done it? If not, you have to implement it going forward for sure. Non-reversal of ITC and non-payment of reverse charge. So non-reversal of ITC, I'll quickly go through it. It's in a scenario where, let's say you have two services. One is exempt and one is taxable. Now, what law says is if there are common credits, a typical example of a common credit is rent. You use the same office, pay rent, pay GST on that rent, but you use the same office for both exempt and taxable supplies, right? So you cannot claim the entire ITC of what you're paying. You need to reverse to the extent of exempt supplies. So let's say I have an exempt and taxable supplies of 50%. I have GST on my rent of 10,000. I cannot claim the entire 10,000 in this case. I need to reverse 5,000 in this case. A lot of people are not doing this. A lot of people do this only at the time of audit, at the time of when the consultants come in and look into the books and they say why we have not reversed, and they eventually end up reversing with interest again. So these are points which, if addressed at day one, would not turn out to be pressure points later on. And reverse charge. Reverse charge is another thing we need to go back and check with our teams. Are we paying payments under reverse charge mechanism? There are certain transactions which the government have notified. A few of them are, if I employ any goods transport agency, let's say I am selling products and I employ a goods transport agency to send it to Karnataka. If I pay him, generally these GTAs are in an unregulated market, so the government cannot expect them to take up a registration and pay on forward charge. So what they are saying, since I am registered, I have to pay on reverse charge. So this is not being done in a lot of enterprises. We have noticed this. Similarly, director fees, sitting fees, not director remuneration, but if you're paying any director sitting fees, it is not expected that the director is supposed to pay GST on that. The company should pay on reverse charge. And if anyone is importing any products on CIF basis, there is a concept called ocean freight, which is presently litigated. But on a safer view, it is our view that you should pay GST on reverse charge on that. If anyone has these scenarios, we'd be happy, because it's a little technical and would take a lot of time to explain. If anyone has these scenarios, we'd request you to just reach out to us. We'd happily explain the backdrop, and we'll tell you as to how to go forward with that. And the last one is difference in turnover of income tax and GST. So right now, government is sharing data between these two departments. Our 26AS, which is a mere declaration, which is a mere statement of our TDS and advance tax that is paid, now has our GST turnover. So the cases that I had mentioned, where there is someone with 18 lakhs of interest and 3 lakhs of commercial rent, these cases are currently being slipped through the cracks right now. But given the amount of data that the government has, these cases would the government would be able to pick out these cases easily. Now, going into some powers and penal provisions under GST, this is a recent amendment that had come to provisionally attach property and bank account. So look at the cases. This according to us is a very, very serious and draconian power that has been given to the officer. It is applicable in cases of non-filing of returns, assessment of unregistered person. Like I had mentioned, someone with 18 plus 3 lakhs of turnover would essentially, when they are assessing his liability, would get covered over here. inspection, search, seizure, demand raised for willful misrepresentation of facts on account of fraud or otherwise, even mere mistakes. The officer has the power to do this. Now it is only for us to pray that this power is not misused, but it is only time will tell. So there was a joke which a colleague of mine, a fellow member of the institute, made on this, which sadly to say we cannot do anything else but take the silver lining and crack this joke. That Buddha says you should not have any attachment in life, but then a GST officer asks him, but can we provisionally attach? So this is the only situation. This is a very serious power that is available, and only time will tell that if it is being misused or not. And so the next case is if there's any significant difference between 3B and 1, which essentially is for people who are fake invoice issuers. So they essentially do not remit their liability. In case there is any difference, there is a power to suspend the GST registration. We had a similar case wherein a person came to us after his GST registration was suspended. The funny thing was this person deals in completely exempt products. He does not pay any tax because his product itself essentially is exempt. So the cancellation happened on Saturday. He came to us on Sunday as an emergency. We reviewed his situation. It took us 2 days merely to identify the officer and set up a meeting with him. We explained to him that he has no GST liability. His non-filing of return was merely on account his accountant had been contracted with COVID and has not come back, and there is after which he has not been able to find the right staff. It happened in November. The officer was very clear: you go ahead and file returns, whatever it is you pay. I will not revoke this suspension at all. We had to round the clock file all the returns in the next 2 days, submit our application again with the officer. He reviewed it and then revoked it. This entire process, even though it was a simple case wherein there was no loss to the government, revenue was not lost by the government, but still they were following this. And you have to understand that once registration is suspended, there is a lot of stigma that is attached behind it. You're dealing with high reputed vendors, you're dealing with high reputed customers who, when once they see that your GST number has been suspended, that means you're a defaulter. That puts you in a bad light for no reason in this case. And powers to arrest, this again, it is primarily focused on cases where there are fraud, false invoicing, there is intention to evade tax. So these powers are available in the law. And again, penal provisions are available. These provisions, so if you look at the last one, incorrect invoicing, non-registration of GST, all these cases are covered, and these generally compound and can become pretty sizable amounts if not looked into from day one. Now, key changes that are expected for 2021 is GSTR 9, which is the annual audit for 1920, is due on February 28, 2021. So if not already started, please go back and check with your teams if they are working on this presently, because the due date is expected on 20th. There are talks that this might get extended or no, but there's nothing official. So we have to prepare for the worst. And e-invoicing will be another major change, wherein contrary to what the name suggests, it's not invoicing on the GST portal, but it's merely declaration of invoices raised in the GST portal, and a unique number is generated against that invoice. It's similar to the e-way concept that is available. It's the global scheme wherein the government wants to ensure that they can track the movement of goods and services end to end. So this is the next step to ensure that for fake invoicing, false invoicing is curbed. And HSN number. So HSN is a unique number given for every goods or services, be it audit services, laptop, whatever it is, has a unique HSN or SAC number. And earlier there was a turnover threshold wherein you would not need to disclose the HSN number. But going forward from 1st April, there will be only two criterias. Any turnover below 5 crores, you need to declare 4 digits, and any turnover above 5 crores need to declare 6 digits. So this probably y'all can note down and then go back to your teams and check if this has already been complied with. So that is my bit on GST. The next portion on M&A, I'll quickly sum up and then hand it over to ma'am. So harnessing the power of M&A. Now, in my short stint in KPMG, I have realized that a lot of small businesses have the potential for M&A, but are uh, are not exposed to it, or do not believe that their business can be sold or can be hived off or can raise funds. It it uh, a misconception is that you need to be a 100 crore company with a huge marketing budget and have your name spread across the country for actually being a potential for M&A, which is not true. M&A transactions happen at all levels. And so this is something that we definitely want small business enterprises also to understand. Essentially, small business enterprises have 2 to 4 verticals in each business. You might have a consulting vertical, a manufacturing vertical, a trading vertical, and maybe a software vertical. Now what you can probably do is hive off one particular vertical into a separate entity and cash that out. A simple example would be Horlicks, which was sold by GSK to HUL. It was one of its verticals which the company had hived off and sold to essentially encash and then lubricate its other verticals which it uses the funds for. So many people believe that it's quite uncommon for M&A transactions to happen at smaller levels. I have only a 5 crore, 10 crore, 15 crore business. I don't know if an M&A can be done over here. It can most definitely be done. We have worked on M&A deals which are small in nature also. So that is something that people should definitely look into if they are looking into selling their business or raising funds. So the next last segment on this would be the process of M&A. I think the most critical point would be to identify the right value. Definitely, the right buyer is there. India being a very investive market right now, there are a lot of startups that are coming up. Because it's a consumer-rich economy. There are a lot of consumers, so a lot of businesses are interested to come to India to start up in India, and it's easier to acquire existing businesses. So in this scenario, I think the most challenging would be, yes, after identifying the right buyer, is to identify the right value. So how do you define the value of a company? You can use discounted cash flows. You can use various different types of valuation methodologies. But one thing what I've learned in my stint in KPMG is that value is defined as a multiple of something. Now let's say it's very common that we hear the company was bought at 10x, 20x EBITDA, 20x earnings, 20x gross profit. So now what is that amount? What is that 10 times that they're paying? So that is the most critical aspect in M&A, because if I, let's say, make an adjustment of 1 crore to that earnings, let's say the earnings were 10 crores and I make an adjustment of 1 crores, the promoter essentially loses 10 times or 7 times. He loses 7 to 10 crores in that case. And 7 to 10 is on a normal scenario. If it's a startup, if it's a tech startup, it can anywhere be 40 times, 50 times also. So 1 crore adjustment would mean a straight 50 crore hit to your earnout. So I think these are a couple of important aspects under the M&A space. So I think that's it from my end. So feel free to please reach out to us, and you can drop in the questions in the chat box. I'll hand it over to ma'am after this, and If there's anything else also, you can reach out to us. We would be happy to connect with you all and take this forward. Ma'am?
Hi, thank you, Vineet. That was such an insightful session. Thank you, everybody, for joining this web conference today and taking out time on a Sunday. And my special thanks to Tariq sir and Gopi sir for organizing and leading such a noble initiative wherein, the alumni is coming together and trying to grow together. So this is a great initiative. I will be briefing you on the new labor code. So I'll just share a presentation which was released by the Ministry of Labor, and then we take it forward from there. So. All right, so I hope you can see the presentation.
Yes.
Okay. All right, so one sec. Okay. So basically we'll be speaking about, sorry?
Yeah, if you would like to make it full screen, you can press Control L.
Okay.
Control and L.
Is this full screen now?
Yeah. Control and L, L for London. Control and L together.
All right.
Be a full screen. Yeah, that's it. Great.
Okay. All right, that sounds good. Okay, so basically we had a lot of legislations, a lot of acts, nearly 44 central acts relating to the labor and employment issues. And there were so many issues pertaining to this particular field, the labor code, that it was getting very difficult to actually amalgamate all and understand exactly how the role is being played. The government decided that probably it was time that all these codes are put into 4 different headings. And why those 4 different headings were chosen, there's a particular reason to it. First, I would like you to understand that labor code falls under the concurrent list, which means both the central government and the state government can make laws related to it. The 4 laws that we have, one is the wages, the second is the industrial relations, then you have the social security, and then we have the OSH, occupational safety, health and working conditions. This will, for some reason, I'm seeing my, I don't know how to minimize this. Okay, there it is. So first category would be the industrial relations code. And this has subsided 3 existing legislations, which was the Industrial Employment Standing Order 1946. So you can see that we nearly had some legislations which were 100-year-old. And now they've all been amalgamated together, and we just have 4 codes that will be basically defining the entire labor code. So first is the Industrial Relations Code 2020. Then you have the occupational safety, health and working conditions. So as the name suggests, this will probably be taking care of the safety, health and working conditions of the workers and the employees. So all the Factories Act, Mining Act, Dock Workers Act, and the list of 13 acts has been amalgamated into one. Then we have the Social Security Code, so which basically has subsumed in it the PF Act, the ESIC, the maternity. So everything related to the social security of the employee. So we start with the Industrial Relations Code. Before I start that, I would just want to brief that these laws are basically aimed at improving ease of doing business and encouraging entrepreneurship. So there have been a lot of talks stating that these laws are employer friendly and not employee friendly. So when we go ahead and see the provisions, the new provisions that are being made in this one, you would understand why is it so. So basically, the rules of retrenchment, shutdown, and hiring, firing have been made much more easier and simpler. Although the government has tried to make social security an important aspect and try to cover more people under the social security, but compliances, the effect on the compliances has decreased. As in, right now there are so many compliances that needs to be done, that will be reduced uh, since this becomes one nation, one code. So a lot of things will be relatively easier for the employers. Now the code on industrial relations 2020. Okay. So the key changes in this one is basically the definition of worker is based on the definition. This is also been defined in the wages code, which was approved in 2019. Worker. Now, this code is also tried to bring in a new definition of fixed term employment. So, this was not existing earlier. Now, there is a fixed term employee, is an employee who's working for a period of 1 year. So, if an employee has worked for a period of 1 year, then he will be entitled to some social security measures. So if you have a fixed term employee, as in somebody who has worked with you for 12 months, then he is liable to get his gratuity. So earlier it was only that regular employees who were with you for 5 years would entail a concept of gratuity, but now the fixed term employees, so somebody who's with you for a year, will also have the benefit of gratuity. So gratuity is calculated based on 15 days salary per year. So employees, the full term employees, obviously, so that's a social security measure. Then you have industrial disputes related to employees. Obviously, this is the industrial dispute code. So you can raise an industrial dispute within a time frame of 2 years only. So earlier the limitation period was 3 years, and now it has gone to 2 years. As a trade union, if you had to go on strike, you had to only give 14 days notice. 14 days to 6 weeks was a notice, but now it has gone to 60 days. Earlier, any establishment with 100 workmen had an exemption and they did not need any approval from the government for prior retrenchment or closing down. But now this limit has been increased to 300, meaning that when this limit has gone to 300, any organization or any unit having 300 up to 300 workmen do not need any approval from the government. They can just close down without any approval, but earlier it was only 100. So this is one pain area for the employees, and this has been given to the small setups so that it is for ease of business. Then there is a provision of grievance redressal committee. So every organization setup has to have a grievance redressal company, and the number of members of the committee members has been increased from 6 to 10. It is also been put in that there should be a reskilling fund that will be set up by the appropriate government, be it central or be it the state. And this reskilling fund is for those people who have been retrenched, or who could with that fund get trained and be employable. So the definition of employee has also been extended. So if you see the definition of employee has also included within itself the audiovisual workers, as in the cine workers, those who are in the film industry also. Definition of employer has been modified. So the definition of employer as per section 2M is the head of the department, occupier of the factory, the manager of the factory, the person in authority who has the ultimate control, etc. Then you see that fixed term employment that we already spoke about. So as I said, that will have a social security impact for the reason that in the fixed term employment, now the employees will get all statutory benefits, that is like ESI, EPF, bonus, gratuity also. So earlier gratuity was a term which would only come into picture after 5 years of service, but with fixed term employees. So these are not regular employees. These are your fixed term employees having worked with you for a year. So the employee becomes eligible for gratuity if he renders services under the contract for a period of 1 year. And the termination of a service of this kind of a worker does not have any implication of retrenchment. So because it was a fixed term employment, so then you don't have to worry about those litigations that would come with contract workers or other kinds of agency employees. The definition of industry has also been modified. So I will not get into much details of what the definition of industry is. Metro railways have also been included into railways and grievance redressal committee, as we've already spoken. Now, there is a concept of negotiating union. So this is basically to reduce the number of litigations or number of disputes that gets raised within an industrial unit. So we see that there's a lot of disputes when it comes to industrial units, and there is an industrial tribunal. So there's a process of conciliation, and after that it goes to the industrial tribunal. Whatever has been decided there in the ID, then it goes to the courts. So there's a concept of negotiating unit that has been brought. So if a industry has more than one trade unions, then whichever union has more than 51% of members would be the negotiating union. So it would be that they will be discussing with the management regarding whatever negotiations that they want to do or whatever issues that they wanted to discuss about. So the trade union disputes would definitely be reduced. There is more opportunity given for mutual discussion and mutual settlement than to take every single issue to the Industrial Dispute Resolution Board. Now, definition of wages has been revised. So, in simple words, I would say that wages has been divided into basic pay, and then there is a list of excluded allowances. So earlier it was that, basic pay could have been anything, but now they've ensured that the basic pay is not less than 50% of whatever the pay is. So 50% you have to ensure is the basic pay. So the salary, the wage is divided into three parts. First part is the salary, like basic salary, reimbursement allowance, etc. Second part is the bonus, conveyance allowance, house rent allowance, overtime allowance, etc. And the third part is that excluded component should not exceed 50% of the total remuneration, as I already said. So your basic pay will increase. So earlier, in the name of special allowance, your basic pay used to be like very small component, and then there were a lot of other components. But now your basic pay cannot get less than 50% of your pay. So negotiating union, I've already discussed. Strikes and lockouts. So there is a period of prior notice that needs to be given for strike or lockout. It is applicable both on the employer and the employee. Now there is also a provision that the employer and employee can refer a dispute to arbitration, but that can only happen with mutual consent, and there has to be a written agreement between both the employer and the employee. The workers who approach the industrial tribunal for adjudication of a dispute or retrenchment cannot go on a strike. That is one provision. Neither can the employer take a adverse action against them. There is a time period for the limitation period, that is 45 days, which has been given for any dispute to be referred to the industrial tribunal. Employers of industrial establishments with at least 300 workers are mandatorily required to take prior permission from the central government before. Okay, so 300, up to 300, they don't need to take any permission for layoff, retrenchment, or closure. But anybody with more than 300 has to do that. So there is a penal charge, penal consequence if they don't do that. Then we go on to the Social Security Code. So the Social Security Code has 2-3 new definitions of 2-3 new kinds of workers. So one is the gig worker, another one is the platform worker. So the gig worker is basically a person who performs work or participates in work and earns from such activities outside of the traditional employer. So we've seen that there's a lot of freelance working and independent arrangements, consultancy working, that has been happening with the advent of technology. And then we also have seen that people who are individuals who are working on specific platforms, online platforms, etc. There's a lot of demand in those kind of workers also, and they needed a proper status to be recognized as a worker. So platform workers, a person engaged in or undertaking platform work. So platform work means a form of employment in which organizations or individuals use an online platform to access other organizations or individuals to solve specific problems or to provide specific services in exchange for payment. So basically, they have also been included as employees, as in their wages and their social security will also be regulated under this code. Again, wages, as I said earlier, how it has been calculated that basic has to be 50%. It cannot go below 50%. Provident fund scheme, there's not much change except that earlier any establishment having 20 or more workers would fall under EPF, and those establishments had to be included in the schedule, but now they don't have to be included in the schedule whether the type of establishment is there in the schedule or not. If you have 20 or more workers, then you are liable to enroll yourself with the EPF and to pay the PF. Similarly, those organizations which were deducting the PF but not depositing, there are stringent provisions made for them. So the amount of penalty has also increased. Although there is one change that there was earlier a sentence also, they've removed that. So earlier it was either imprisonment or fine. Now I think imprisonment is not a mandatory this thing. It is only been limited to fine. Then the ESIC, so ESIC also has seen a little overhaul, as in the gig workers and unorganized sector. So unorganized sector was earlier also into the ESIC scheme. Now it has also extended its facility and it is available across 740 districts. So even ESIC contributors, employers cannot fail to do it. It is an important responsibility that they will have to ensure that the ESIC is properly paid. Otherwise, there are penal consequences to it. Gratuity, as such, the threshold period of gratuity has been decreased, I would say, for some workers to 1 year. So that is the fixed term employee. Even after working for 1 year, they are able to get the gratuity benefits. The newspaper journalists, working journalists, they have also been included in this scheme. As such, for these working journalists, the period of gratuity has come down to 3 years. So earlier, until 5 years, they wouldn't be eligible for gratuity, but now after 3 years, they are eligible for gratuity. So we have fixed term employees who are eligible after 1 year. We have working journalists who are eligible after 3 years, and the regular employees who are eligible after the 5 years. So employment information and monitoring, of course, when these are very common ones, and maternity benefits. So earlier there was a provision wherein there was a ceiling of upper limit. Now that has been amended, so there is no upper limit ceiling for maternity benefits to be provided. Earlier it was 20,000 as per the central government, but now there is no upper limit on the medical bonus or medical amount to be paid to the female employee for maternity benefits, towards maternity benefits. Now, I'll go to the Occupational Safety, Health and Working Conditions Code. In this, so a single registration, this was a major concern. Now the code provides for a single registration of an establishment. So once you have a registration, that will be considered across. So you don't have to have multiple registrations, as there will be a centralized database, and that will help in the ease of doing business. Appointment letters have been made statutory, so you have to ensure that every employee is being given an appointment letter, and that appointment letter should capture the terms and conditions clearly. Working hours for women, so night shift for women can only be provided for with their consent. So if they have consented, only then they could be allowed to work for the night shift. And for night shift, there's an approval that needs to be taken from the central or the state government. Similarly, the duties of employers when it comes to health and safety measures, etc., are the same. They still have to maintain the register and ensure that health and safety compliances are in place. Again, the offenses, there are penal offenses for not complying to the health safety standards as prescribed by the code. Also, as I said earlier, that audio-visual production units, including feature films, non-feature films, television, web-based serials, etc., these kind of workers, the dancers, stunt people, they've also been covered with respect to the wages ceiling. So in social security also they've been covered, and with respect to wages also they've been covered. Similarly, principal employer must provide all welfare activities wherever contract labor is deployed, and principal employer is liable to make payment of wages to the contract. So there's a lot of issue that we have seen in the last 2 decades with contract workers and the principal employer, as in who is the principal employer for the contract workers. And most of the times they don't end up getting payment through the agency, although the agency is being paid by the employer, but the agency had not made proper payment. So now this code has made it clear that the principal employer will be the organization, whether they've made appointment through the agency, but the principal employer is the organization for which the contract employees will be working. So the working hours for the establishment, that will be dealt with by the particular state government. Overtime pay has to be made, and that will be twice the rate of the daily wages. So overtime pay is another feature. It was there, but now this will be a little more strictly implemented. Definition of employee is again elaborated, as in more people have been included into the definition of employee. Similarly, definition of employer. Definition of factory, these are basically the definition: hazardous substances, industrial premises. I'll skip the definition. All right. So I'm just going to cover other few points. I'll stop sharing the screen. And I'll just, there are a few questions that I would pose and also answer them at the same time. So basically, out of the slides that we have seen, what exactly is the Code on Industrial Relations trying to say of the trade unions? So there is a negotiating union, that is the point to remember. Then what are the provisions on layoff and closure? So related to layoff and closure, any organization having more than 300 employees need to take an approval. But anybody with less than 300 employees, they do not need to take any approval from the government. And, it won't be illegal for them to just shut down if they wish to. What about the right to strike in industrial code? So even the right to strike, it won't be a breach of contract if they give a 60-day notice. So if there is no notice, then obviously it's a breach of contract. So the pros for the industrial relation code is that it's a welcome change for the employers, because now they can employ up to 300 people without worrying about the government approvals for firing them. And obviously it's a con for the employees. Then when we come to social security entitlements, then it's an important point to remember that employees definition of employees has been increased. There is a fixed term employer, there is gig worker, there is platform worker, there is all these audiovisual productions who have been included into employees. um, there it is. So for the fixed term employee, within 1 year, they have the gratuity for audiovisual, that is the cine work, the working journalist, you have 3 years gratuity. And for other regular employees, it is the 5 year gratuity. Then we come to occupational health and safety. In this, there is a definition of interstate migrant workers. So now the non-core activities that has also to be regulated, in the sense that the occupational health and safety compliances, the wages, so the wage has been capped at 18,000, so everybody under that would fall under the definition of worker. Other than that, most of it I think I've covered. So basically, there were only 5 changes, and those were the layoffs, which have been made relatively easy. Reducing of union conflicts. Then there's a minimum wage, settling minimum wage, which is capped at 18,000. Then social security net has been increased, and the fixed term labor has been recognized. So with this, I conclude. If there are any questions, I'll be more than happy to take.
Yes, thank you very much. Vaithisaran, would you like to take the questions to the speaker? Or we can unmute the participants and ask them also. Vishwanath has a question to ask Shreyans. Vish, you can go ahead.
Yeah, let me show my face. Yeah. Hi, Shreyans. Vishwanath here. We are the MSME sector.
Yeah.
And then we got this product development done by the Incubation Center for IIITDM, which is a Central Government Institute.
Yeah.
So they have something called Made It, which is basically an incubation. That's the name they are given. And the project is well on the way, and we'll be hitting commercial thing probably we're trying to do before March, but at least before June we'll definitely be hitting the commercial thing. My question is, who certifies it as a startup? I mean, because they will say it is a success. Then do we take that letter from this incubation people and take it to the income tax department and get a certificate, or based on this whatever the incubation center issues as a startup, we can, I mean, our auditor can stop paying tax?
So that's not how it works. So firstly, I would like to ask you whether your organization is a private limited company or LLP?
Yeah, we are converting into a private. It is not. Can you unmute? I mean, I'm not able to. You are muted. Yeah.
Now can you hear me?
We are a partnership. We are converting into a private limited just for this sake. They in fact, they are insisting that we should convert to a private limited company to enable us as a qualified startup.
Yeah. So the process is, there is a governmental organization called Department of Promotion of Industry and Internal Trade. They have created an online portal, www.startupindia.gov.in.
Yeah, we are registered in the Startup India, right?
And you would have got a certificate of registration from the startup, this thing.
Okay.
But you must have been a private limited company or LLP to enjoy this particular tax benefit.
No, we are converting. See, the research is going on. See, we are making samples and submitting to this central government educational institute to do the testing and evaluation and getting the patent, and those kind of things are going on.
Correct.
So I mean, it's well on the process. I mean, maybe another 3 months, the project will be a success and we'll start commercial launch.
Right.
But so before that, we'll convert to a private limited also. That also we'll do before that. Now my question is, who certifies us as a startup? When so that 21, 22, we want to avoid tax. That's the whole idea for 3 years.
given your scenario, once you convert to a private limited company, then you will have to go and register yourself with startupindia.gov.in.
Again.
Yeah, under that company's name.
Okay.
Give your idea, give your pitch deck to the government, and then they will approve and give you a certificate of registration as a startup.
Okay.
After that, there is a separate process to apply for Section 80 IAC exemption. That is a tax exemption. So the first stage is you get approval as a startup from DPIIT by registering a private limited company in that particular portal.
Yeah.
Once the approval comes, the second stage of approaching the interministerial board for this particular 80 IAC exemption has to be done separately through that portal only.
Will you be able to take up that thing of getting the approval done? Because your company.
Yeah, we can definitely help you offline. Our contact numbers have been shared.
Okay.
We would be more than happy to help you out.
Okay. Thanks. Once I reach that stage, I'll come and be in touch with you. Thank you.
Sir, HPSP, I have a few questions. You can unmute and ask the questions, sir. HPSP. His question is, what are the impact value added tax on tax reforms? To whom, sir, these questions? HPSP, unmute, sir.
Hi, good morning, everyone. Anyone can answer my questions. So there are 4 questions I've already posted. Whoever is interested can answer my questions. There is no particular person that they can address it. Thank you.
Thank you, ma'am.
Ma'am, can you introduce yourself?
I'm Haripriya Suresh Babu, Executive Director, Vikas Industrial Park Private Limited. We are into manufacturing companies and other things, like we are into the development of industrial park. So I would like to know about the taxes and its benefits, if at all it's been started with that kind of a thing. Whatever the questions I posted, that is related to my work. So I would like to know about it.
Excellent.
So I'm 93 chemical Annamalai.
Thank you.
Yeah, I have a question for Vineet.
No, actually, sir,
I have a question to Vineet.
Yes, sir.
Vineet, for zero rated sales, can we take the input credit for zero rated sales?
Can you just repeat your this one again?
For the zero rated sales,
Right.
can we take the input credit of
Yes,
the raw
sir.
materials?
Yes, sir. But
Yes.
capital goods cannot be allowed.
Okay.
You can take on raw materials.
Yeah.
Is there any other sale that is there in the company?
Yes. We do the local sales also, for which we charge the GST.
Okay.
In addition to that, we are doing a lot of zero rated sales and also few exports. So can we take the input credit for those kind of transactions?
Sure, sir. You can. Zero rated sales. Can you tell me what is the transaction that you're doing? What is the product that you're selling?
It is meant to the MEPZ zone or SEZ zones, in which they totally export the products outside of the country.
Sure.
So can we take the input credit? We can take the input credit.
Yes, you can.
For exports, for direct exports also, we can take the input credit. Am I right?
Yes, sir.
Okay, thank you.
Yeah, thanks, Chenny. I think.
Thanks, Tariq. Thanks.
Vineet, you can take up those questions posted by Haripriya in the chat box.
Sure. Yeah, just a second. If I can ask ma'am to come back online and just discuss these questions one by one, we can address them. Because what are the impacts of value added tax on tax reforms? So I'm not able to understand as to where is she coming from with this question. So if she can just explain that, I'd be happy to. Or if she wants, I think she wants me to explain the impact of value add tax, how GST does it. Can this part alone, ma'am, if you can just explain?
Yeah, that's right. Whatever you have said is the right on the
GST. Got it. So if you would recollect in my example, wherein GST is also a value added tax, so was VAT, But the main issue earlier was it was disintegrated. That is, we had VAT separately, we had excise duty separately, we had CST separately, and in some cases we had entry tax in some states. So it was disengaged. Now this is where GST has come in and subsumed all these other acts, wherein you have only GST, except in the case of petroleum, wherein the government has the right to not it's not been brought under GST. So everything else gets subsumed under GST, and GST as such is a value added tax. So let's assume in the example that I gave, I bought a laptop, I paid 10,000 to my vendor, so I paid him 1,10,000. I sold that laptop for 2 lakhs, and the tax on that is 20,000. So what government says is the end result. What did I sell the end product for? 20,000. That is the revenue which the government should get. So now how does this get achieved? 10,000 my vendor pays to the government, and when I go to remit, I say that I need to pay you 20,000. 10 was already paid by my vendor. 10 I am paying you by taking input tax credit. Now that is where whether input tax credit is allowed or no, there are provisions in the act which say that some input tax are blocked, some input tax are allowed, and in some cases you need to reverse some partial input tax credit. So if I hope I have answered your question as to how this. Now if let's say the person who I sold that 2 lakh laptop to decides to sell it to another person for 4 lakhs, so at the end of the day, the government is supposed to collect only the net, the final consumer when they buy the product. What is the tax on that? Now, when he pays, let's say for 4 lakhs for 40,000, he will claim the 20,000 I give him as input tax credit, and net he will remit 20,000. So the government at the end of the day collected 20 from the third person, 10 from me, and 10 from my vendor. So in essence, the government collected 40,000. That is how the value added tax system works.
All right, thank you. The other questions?
Yeah.
Anybody else?
Yeah. So the second question is the scale of the occurrence of unethical practices in business correlated with the size of shadow economy in domestic economies? If I understand the question right, by this, I think you mean that the amount of unaccounted money and other things which are underreported to government, and how does shadow economy correlate to it, correct? Is that what you're asking?
Yeah, you're right. Yeah.
Particular
As you
government,
answer, if I have any questions, I will post also that. Yeah, please go ahead.
if you see this government, since it comes to power from 2014, it has a very targeted agenda. Generally, unaccounted money is parked in 3 major areas, which is your cash, real estate, and gold. Correct? Now, with demonetization, cash was attacked very hardly. With the advent of GST, people started routing everything to bills. If I get material in bill, I will have to give the bill to claim input credit. And then with real estate being more and more tighter, you need to present your Aadhaar card, your PAN card, even if you get a property registered. And if you register at a lower value or a higher value, you are immediately taxed for capital gains. All that has basically controlled a lot of black money or uncirculated money being pumped back into the system. With this, we are slowly on the path of becoming a regulated economy. If you spend more than 10,000 in cash, you can't claim expenses in your income tax. You can't give loans in cash. You can't repay loans in cash over 20,000. Gold has now started being regulated with jewelry industry coming into PMLI Act, that is Prevention of Money Laundering. So you are right. As a history, we have been uncompliant and more dependent on a cash shadow economy system, but we are moving towards getting systematized year by year.
So I think the next question is, what is the impact of using ITC in taxation by the government? So I think
ICT, yeah.
ICT, I think you mean input tax credit, right?
Yes, input tax credit. I think I misspelled it.
Yeah, no problem. So I think that
ITC,
can be correlated to my first example which I had given, wherein if I don't have input tax credit, it's a cascading effect in the cost of price. So in this scenario where I purchased the laptop, I purchased it for 1 lakh and paid 10,000 GST. If I don't take that GST, essentially that becomes cost. So my cost in the next scenario becomes 1,10,000. When I sell it for 2 lakhs, I cannot claim that ITC. So my profit then reduces. So what I'll do is I'll invariably sell it for 2,10,000. And then the next guy, instead of selling it for 4 lakhs, might sell it for 4,40,000. So there'll be a cascading effect when it comes to cost, and end consumer might have to bear the brunt for that. So that is where input tax credit is essential for a B2B scenario, wherein a business utilizing these services would be allowed to take input tax credit and make it thereby cheaper to avail these services, and essentially reduce the cost of its services which is providing to the customer. Does that answer your question, ma'am?
Yeah, thanks. Thank you.
What are the indicators that can be used to direct policies through the state budget to achieve reforms in the tax system to achieve its financial goals? You want to take this?
So I think the last question is more state driven, state budget driven, and it relates to a particular state's economy and fiscal policy.
Yeah, you can talk about Tamil Nadu. Yeah, our own state.
See, there is always, if you see, not just Tamil Nadu, but most of the states in India are always dependent on center for funding. And despite states having a good chunk of taxation income from alcoholic liquor as well as petroleum, as well as a share of state GST, there is still always some deficiency in terms of funding. And a lot of it has to be connected to the subsidies and, in a sense, support given to people, as well as the spending on infrastructure. And it's more bureaucracy driven than actual lack of funding. So if you see one project gets stagnated, the amount which is already blocked partially does not achieve its end result also. So in order to free up funding, probably the first stage would be to relook at infrastructure block projects, try to clear them up with a fresh quotation and with time bound this thing, so that these amounts which are blocked either are released or the achievement of the particular project is done. And the second stage would be probably identify that state's consumption as to which local produce is being consumed more, and push for a probably local cess or some extra taxation on it to bolster its revenues. But then to see whether these revenues are correctly employed for the right means, that is something which probably the state government needs to see, because execution is more important. Funding will always come, people will keep filling petrol, people will keep consuming liquor. So dearth of funding may not be the main issue when compared to how the funds are deployed. That's our 2 cents on it.
Sir, I have a question here. I am Kannappan from 91 Mechanical. Earlier, the PF was 1,290 or something maximum. Now, what is the maximum they have fixed for this time, this 2021 wage code?
All right, so I'll answer that. So the PF is normally a certain percentage of the basic salary. So now that the basic has been fixed at 50%, the same will have an impact on the PF contribution also. So there are some rules which are being drafted right now. So the codes have come, but the rules have not come. So as soon as the rules are out, you will get to know the percentage also.
And another thing is, now earlier we used to give the gratuity settlement for 15 days basic per year for 5 years.
Yes.
Now again, the method has come, or it is still yet to come?
It will be 15 days basic only.
15 days basic.
Yes.
Okay, fine. Thank you. And I have one question regarding this GST. We are having a wind turbine generator. Can we take credit for that ITC credit for the insurance and other maintenance charges which you have paid?
Sir, what is your current business?
Current business, we are into sheet metal industry or a manufacturing industry.
Sheet metal manufacturing.
Yes, we have wind turbine also, wind generator. And we are selling the power to TNEB.
Power to TNEB GST will not come, but
GST is not coming, but we are paying the regular AMC maintenance charges.
Right, right.
Then
And you're taking
security
insurance
charges and all,
on that.
insurance. And we are purchasing also.
So this in this scenario, I would say it will not be allowed, sir, because this particular asset is specifically being used for a revenue on which GST is not applicable. So there is one-to-one correlation. Now, when in my previous example, when I had told exempt and taxable supplies, I had mentioned common credits. So common credits being the common rent paid, common if there's any marketing expense, so that cannot be defined as to it's marketing for that company. So in this case, it's very clear that this is a GST that you're paying specifically for this wind turbine, and hence I would not say that it's allowed.
Do you have a list of services or goods where ITC cannot be availed? See, now there is a lot of confusion. Some of them say that you can take ITC for the car maintenance, the car used by a MD or a manager. And some say that bikes can be taken since service people are going. And for company vehicles which are used for goods delivery and all, you can take like that. Can you just share some these things where we can take and where we cannot take?
Sure, sir. There is a list which we have. We can probably circulate it through Mr. Gopi, and he can share it with the business network, so that you can refer it to your internal team and fix certain guidelines that these are the items on which you cannot take GST. So if you have been taking, kindly make necessary changes going forward at least.
And you told that the interest is 24% or it is 18%. Earlier it was 18%, right?
No, sir. Yeah, 18% if you have not paid, but 24% if you have wrongly availed ITC. There are two slabs. Okay. If it's a mere non-payment, then they will charge you 18%. But if you have wrongly availed, which in most cases we do because unknowingly we assume that it's allowed and we go ahead and take it. 2 years down the line or 1 year down the line, we find out it's not available. So it was a credit that was never available to you, which you have taken. So in that case, it would be 24%.
24%. And can you tell more on the GST procedures and the returns to be filed for job working? We do job work for our customers.
Yeah.
Some ITC 4 or something is there.
Correct. ITC 04 is there.
That.
Correct. So that is to be done by the principal every quarter. So whoever he is sending you that job work materials, he should file ITC 04 every quarter.
Every quarter. So
yeah.
Same case for our job workers, we have to do when we send for some plating or heat treatment outside.
So what we can probably do is I can connect with you offline also, and we can give you the extensive compliance check which you need to do for in your case job work and other clarifications that you have with regard to ITC and claiming GST.
Fine, sir. I will take the number from them and speak to you.
Sure.
Thank
sir.
you.
Thank you, Mr. Kanappa.
One more question from me. Actually, we wrongly taken the ITC means now we go and review it back or like that. Anything is there?
Wrongful availment can be due to multiple scenarios, sir. One could be a mere clerical error. Some cases you must have thought that it is available. Later you come to know as per law it's not available. So if it's a mere
what is the procedure to inform? We go and inform or we wait for action?
There are two methods, sir. If your time, that financial year is already over, you have filed everything. September month of the next year has also gone. And then later you identify, there is a form called DRC 03, where you can give a voluntary intimation and pay the input reversal with tax and interest and finish it off.
Okay. Then also interest will come.
Yeah. Within the financial, interest will definitely come, sir.
Okay.
within the financial year itself, if you identify that previous month I had wrongly taken, next month I have due to some clerical error or something, in the next month's 3B, you can adjust it.
So how it's from 18 months or before that also it will come?
From the period you wrongly availed till you rectify, the interest will be calculated for that portion.
Okay. Okay. No, initial stage when the GST comes, that time we are made everything in that will affect now.
So if let's say your case is picked up for audit and they identify these lapses, then they would ask you to reverse and pay that money.
Okay. Oh. Thank you, sir. Any other questions?
Sir, can I, excuse me, can I have a question here. This is about GST only. It's generally monthly return for companies whose turnover is above 5 crores. And in between, if it goes down to less than 5 crores, then it becomes quarterly return. Am I correct?
So, there was a new scheme called QRMP, Quarterly Return Monthly Payment Scheme, which was recently introduced.
Okay.
It talks about your aggregate turnover of the previous year. So now
Okay.
the financial year 2020-2021. So if the previous year, that is financial year 1920, your turnover was aggregate turnover was more than 5 crores, you cannot do it quarterly. But if your aggregate turnover was less than 5 crores and you had been filing correct returns, the system must have by default migrated you to a quarterly system. Or
Okay.
you can manually also opt for a quarterly system before, let's say for Jan to March quarter, before 31st March, you can opt whether you want to go for quarterly or monthly if your turnover is less than 5 crores.
So I file the return quarterly, but pay my tax monthly.
So there are two options in this quarterly return monthly payment scheme. One, if for that particular month you see that your output is less but input is more, you need not pay any taxes.
Again, when coming to the input, are we supposed to take the credit of only that is shown there? That is the suppliers who have filed the return and it's been reflected on, or can we manually change it as it has been possible till now?
So, which is what Vineet was saying in his earlier presentation. Till probably before December 2019, there was this idea of where you can, manually do it. From 1st January 2020, the law itself has been amended saying that you can claim ITC only if it appears in your GSTR 2A. And it will appear in GSTR 2A only if the other person uploads it. And that also, if the other person uploads it in time, then you can take it in that month. If he uploads it after the due date, you can take it only in the next month.
Again, this is uploading it's reflected there, but they have not filed the return.
That is also a case where they will upload and keep, but they will not attach DSC.
So what do we do?
Not considered.
We cannot take.
Yeah. So there is this return. See, there are two returns. There is one GSTR 2A and there is one GSTR 2B.
Okay.
2A is where for the month, if anybody uploads, it will come with signing or without signing, it will show you. But 2B will show you how much you can take. It will show you the people who have uploaded in time and who have also attached their DSU. So
then why is the sorry to interrupt? Why is the column where it should not be manually changed? No, it cannot. It should not change. No, then why is the return still be able to change manually? Why are we able to change it manually?
So see, there may be many adjustments which are not just limited to input tax credit. What if some adjustments are there in previous months which you have identified a mistake now or you want to reverse it? What if there are some entries of previous month which you have missed out, but now you have reconciled and found that it had come in my 2B, I didn't file it. So that if this manual option is not there, then you won't have any mechanism to claim this.
So the columns where we can adjust the previous, correct our previous mistakes, that alone should be made manually changeable. But the other, the ITC part of it, where we should not be able to change it manually. My point is, I'm asking if the government is so serious about the ones that is reflected in your return, that only you should take it, then why make it changeable?
So if you see, it is a phase by phase process. There can't be a single shock mechanism to do what you're saying. Government's plan is to implement what you exactly are saying. But since GST is a comparatively new law, if you see from 17 there was a system. It slowly developed and this came. It slowly developed, now 2B came. Now if you take wrong credits, it becomes red color in box. As people become more and more aware, from 1st April, e-invoicing is coming for more than 5 crore turnover people also. Probably 2 years or 2.5 years down the line, what you say will only happen. If it comes,
so till then, why not we use that? See, every pie is money only. It adds to our. When the government is not doing it, why don't we avail it?
No. Government has already done it. It is showing you a red color box that you are claiming wrongly. Now it's up to you whether you want to do it or not.
Okay.
Now, if
Yeah,
you
my point is that it should not be editable.
No,
And
the
since it's editable, why don't we take it? Use it.
no,
We're
the
not
system is
evading
just
tax.
evolving
We are
now.
using it. That's all.
Probably I just want to add one point over here. Sure, your point is absolutely right. It's to say that if it's editable, I should be able to use it. The editable option is the government is very happy if you take a lower credit. So the point Shreyans was saying that what if I claimed what if I my output tax liability I put 43,000 instead of 34,000. It is a simple manual error, and I have I want to correct it in the subsequent period, which is what essentially government wants you to do. You make corrections in this. So let's say I'm allowed 100. There was some previous month error. I wrongly availed extra. I'm adjusting it now. Anytime you start taking extra, presently the box becomes red, indicating that you are violating the provision. Now, going forward, maybe they will start questioning people who are making it red. The next step would be not even allowing people to take anything that is not appearing in the 2B. So you're probably just your question is 2 years in advance. In probably the next 12 months to 24 months, we are heading towards what you're saying right now.
So that's what I'm saying. If we are heading
So
towards
exactly, my point is, if you're right now you're availing the, let's say you're allowed only 100, you have 120 rupees the vendor did not upload. You're saying I want to go ahead and claim it because the return allows me to. Sure, you can do it. You can file it today. The return will be filed successfully, but it will be marked in red. Now going forward, they will send you a notice saying, why did you claim? Can you give me a breakdown of the 120 that you claimed? They will compare it with the 100 and say that this 20 was not uploaded by a vendor and was uploaded only in the subsequent month. Potential interest can fall onto you in that scenario. Now, why does it allow you? I don't know. Maybe they're okay for you to make this error so that
that is my point. Why blame us? We have paid the money and we just can't take credit.
Absolutely, absolutely. I think your point is it's highly unfair that when my vendor does not upload, why should I be penalized? It's a 100% safe argument, but right now the law is it does not need to be fair. It's strict. So that is where we are also in a very precarious situation when we tell clients that they cannot claim this credit, which in their minds they are rightly entitled.
Yeah, I just want you to all maybe represent it to the government through your organizations. Like, why don't they consider wherever that is, it is at least reflected there. From the invoice itself, we can take at least, even if they have not filed the returns. Because filing returns, again, there are again a lot of other sections where it says quarterly, monthly, I don't know what else. So why we don't even, because they are quarterly, we just can't wait till 3 months.
Correct. So,
or only if we know if they are quarterly returns, then we can't go and get it from them. It is not like that, no?
Yeah, so now they have introduced something called as invoice furnishing facility for these quarterly filers. So what happens is if you are a quarterly filer and you have B2B invoices every month, you do not file GST or 1 every month. You can just give the details of this invoice in an invoice furnishing facility, which will allow you to take the credit monthly.
Oh, then that's fine. So this called invoice furnishing.
Facility,
What is it?
IFF.
Oh, but then again, they said IFF. Even if it is IFF, you can't take credit.
You can take credit.
You
If
can take
IFF is up, IFF will automatically get closed by 13th of every month. So there is no concept of late filing of IFF. If I am a quarterly filer, January month I have made 10 sales to B2B people. They will ask me, sir, please upload in IFF. I have to upload it before 13th. Otherwise, I can upload it only next month.
So this is only for quarterly people, quarterly filing people.
Yes, quarterly filers. So this precise problem of yours was existing before December, where quarterly filers ka credit used to appear all together at the end of the quarter. But government wanted to block credit before itself. That is not coming into way. For this, they told that you continue paying tax quarterly basis, but B2B invoices, you show it in IFF so that these guys cannot be denied monthly income tax, input tax credit.
Now, what about customs duty? Again, this customs duty also, we paid customs duty, but they have not, the government, it's obviously the government, it doesn't reflect in our ITC. And they say, when we ask them, they say, you can take it even if it is not reflected next month, we will do it.
So bill of entries are also now seamlessly being uploaded in GST portal from recent months. Earlier it was not coming into way, but now if you see, they are in the process of addressing this particular problem, and most of the bill of entries these days are flowing seamlessly from IceGate, from the customs portal to GST and showing your ITC amount. And probably by next financial year, I don't think this issue you will be facing. Already now itself, it's pretty strong.
Thanks a lot.
No problem. Thank you.
Vineet, I have a question. See, why should not we pay the taxes directly for the purchase bills? What we are doing when we purchase some components or some raw materials, we pay to the purchaser. The purchaser in turn is not correctly paying the taxes to the government. But why should we be penalized? If they allow us directly to pay the taxes for the purchase bills, the whole procedure becomes very simple, no?
You're absolutely right. So what you are proposing is a 100% reverse charge mechanism system where, the burden of paying the tax is only on the person purchasing. The problem with that is,
yes,
you can't always pay the tax again and again and keep claiming it in that month. Plus, at the same time, to address your very problem, what you are saying is absolutely valid. I cannot be penalized for the fault of somebody else. In fact, this particular point is under litigation. There was a case in Delhi VAT where government told that this is wrong. Delhi VAT also had this provision where the other person, if he doesn't file, they did not give credit. Supreme Court went and told the Delhi VAT department that this is wrong. It is against fundamental principle of constitution. You don't have a control over other person. You can't control his actions. If this guy has paid it, you have to give them credit. Now, GST to tackle this very issue, that is why this entire mechanism of 2A, 2B has come, sir. If your accounts department or you guys in the first month itself see whether that guy has uploaded or not, you can immediately stop their payments. So which is what we do for our clients. Before, there are a few checks you can do, sir. See, there is one wish list we have, and there is one law, which is the law of the land today. And as of now, we have to follow the law of the land. How best we can prevent ourselves from such mistakes? There can be a few checklists. Before you buy from any vendor, you can check his GST history, which is publicly available data, whether he's filing on time or not. If you put his GST number in the GST portal, it will give you the complete filing table. Once you give him the order, you can check whether next month it's coming on time or not. If it's, you can block, in fact, the tax component and pay him the purchase price alone. And once it reflects, you can release the balance payment to him. That's
yeah, I agree totally with you. See, if it is going to be a one-time purchase, if I'm going to make a regular purchase, I will have a control over that fellow. It is only one-time purchase. So for one-time purchase, how can you control?
So, which is where you'll have to rely on the data available on his GST portal and see his credit history, sir. Obviously, before giving the order, we also verify a particular person's
So
background. Right?
even though if I pay, I should pay the penalty for that.
So as of now, the law is that only. It is again debatable. It is under courts. Litigation is going on. There is a case in Bharti Airtel case is currently standing where government has asked for comments from where the court has asked the comments from government that why are you penalizing in GST itself, and this case is still under judgment. But law which stands today, only if you get in 2A you can get credit, otherwise you cannot.
Yeah, that is what, if we are allowed to pay for the purchase bills, it becomes one point source. That's all. It is easy. It becomes quite easy.
That's
So
absolutely.
the government can also hold only one fellow. Instead of holding two fellows, only one fellow can be held responsible for that. It is more simplified, I feel.
That is absolutely right. Point well taken, sir.
Thanks.
So one question from Balamurgan. Please clarify the transport cost is exempted for GST.
So transport cost in the sense, if you are, let's say, running a business and you pay freight to your transporters. There are two types of transporters. Some transporters may be registered under GST. Some transporters who are not registered under GST, but they give you a bill where they say that tax is to be paid on reverse charge basis. In those cases, you have to pay the tax at 5% on reverse charge and claim the credit. There are a certain category of transporters who charge GST on their bill at 12%. In that case, you have to pay to the transporter and claim the credit of 12%. So depending upon the transporter you are working with, this particular provision of taxation is how it works. So if that transporter has opted for RCM, then for him, there's no tax liability. You have to pay. But if he is under forward charge mechanism, he will charge you at 12% and you have to pay and claim credit.
If we pay 5% taxes as a reverse charge mechanism for the transporter, can we claim?
Immediately.
Can we take the credit?
That month itself you can claim, sir.
No, I came to know that only when we pay 12%, we can take credit. In case if we are going to pay 5%, we cannot take credit.
That is for that particular transporter, sir. For you, you are paying on RCM, you can claim credit immediately.
Even if I pay 5%, I can take.
Yeah. You can.
Even if I pay. Okay. Not.
You are not the transporter. No, you are a businessman who is utilizing transporter services.
Yes.
You can claim, sir. So what you are saying is for the transporter, sir. If I am a transporter, let's say I am VRL Logistics, I have two options. Either I can ask my customers to pay on reverse charge basis. In that case, I cannot take input for anything. If I buy trucks, if I buy stationery, I cannot take input on all that. But I have the second option where I can charge you guys at 12%. In that case, I will be allowed for ITC. So as far as you guys are concerned, if the transporter asks you to pay on RCM, you can pay and claim ITC seamlessly.
No, my transporter doesn't have any GST number. What I do is I pay 12% and get the recredit of the same.
You need to pay at 5% only, sir.
5% and I can take credit back.
Sir,
Thank you.
One question. Now you said you can take ITC for purchase of truck. Is it applicable to us also for manufacturing industry when we buy trucks?
So, there is one particular section called section 17, which particular deals with block credit of vehicle. I'll read out the section for you for this particular point.
No, the purchase of the truck, and it is used only for transport of our goods, not any other person.
Correct. So what this particular section says is, if you are buying a motor vehicle for transportation of goods, then you can claim input tax credit. Now, there can be two scenarios. In this, and take credit. No.
I'm talking.
So let's say Tata Ace or Bolero or a truck, Tata lorry. All these are meant for transportation of goods, and you are using for transportation of goods. In that case, you may be able to take
for bike and for an MD car or a GM car, we cannot take. Right?
We cannot take, because vehicles which are meant for transportation of persons having seating capacity of not more than 13 people, you are not allowed to take ITC.
And how about the insurance for these vehicles? We can take this thing.
For the lorry you can, but again for the passenger vehicle you
And
can't.
for the maintenance part?
Same, for the lorry you can, for the MD car you cannot.
Fine. And how about the reverse charge mechanism for the security services we are availing?
9% plus 9% CGST, SGST, 18% you can pay. And
18%.
ITC.
Fine, sir. Thank you. Thank you.
Question, Dana sir, you unmute and ask the question, sir.
Good morning, gentlemen. So thank you for the organizers for bringing in these people. Thank you very much. I have a query. I think I have to quickly rush. See, I bought a product, a chemical from an importer. Okay. He charged me 1 lakh rupees for input, for tax. Okay. While filing, I filed 1 lakh and took input credit. This is about a year back, more than before all these things came. Lately, I found out he has put the invoice for 60,000 only and paid only 60,000. Okay, very lately I found out. He has given me over the mail only the invoice for 1 lakh. What I did is I made a, we raise a query, no? What is it in the GST portal itself? Okay, I raised the query and I went and checked with the Anna Nagar GST service department, the central government. They told, no, you can avail only 60,000. Tomorrow, the difference you have to pay. Can you clarify, sir, please?
Yes, so it is related to the question. I think sir earlier asked that if the other guy faults, why am I penalized? So as far as the law stands, sir, there is one section called Section 16 in GST Act, which lays down the principle of when you can claim input tax credit. One of the points there is when the tax has been deposited to the government, only then you can claim. Are you able to hear me?
Yeah, I am able to hear.
Yeah.
See,
So
I have an invoice charged as 1 lakh.
Correct. So
I have the proof.
In this case, what will happen is GST department will probably come and tell you that in 2A it's only that much. Physically it is here. So they will use this particular section 16 and try, telling you to reverse the balance 40,000 ka credit. You have two options here, sir. One, like how the case is standing in Bharti Airtel, where the decision is still not taken, you can take it to the next level of litigation if they are not agreeing based on principles of natural justice. Or the second option is you can approach the regular courts for remedy under civil law, saying that this guy has forged a document and try claiming it from there. So these are the two options you have available. But because of this section 16, the government has an upper hand.
Okay. Is it not for the responsibility of the GST to
that is the whole point of this entire case law of Bharti Airtel, sir. That I have done my responsibility. Just because the other guy is at fault, why do you penalize me?
Okay, thank you very much. One more quick query. See, I am taking material from Mumbai and supplying to tanker. I'm taking from Mumbai and supplying to Pune. Okay, the product is originally meant for Rajasthan. I'm taking from a distributor. So what is happening every time? I am making the invoice and the what you call this GST. Yeah, I'm doing it and giving to my transporter. My supplier gives to me after 2 days, as if the product has gone to Rajasthan. From there, he is giving me a invoice and this one, transport thing. So will it be a problem? That means I'm not having product, I'm selling.
This is a case of bill to ship to, sir. Basically, it's not uncommon where I need to bill one person and the product goes to another person. So in this scenario, the person in Mumbai is billing you, but the product goes to Jaipur. So as long as he mentions where it's being shipped to, and that's being mentioned in the invoice and the e-way bill, you will get the input tax on that, sir. That should not be a problem.
No, I'm getting the input tax. My problem is tomorrow will it be an issue? See, I'm not having product. I am raising a e-way bill. I am raising an invoice, and if my accounts are checked, it will come without product. I sold something.
Which is okay, sir. That's not the problem. As long as the e-way bill and the invoice has bill to your address and shipped to the address in Gujarat, it should not be an issue. That as long as that is mentioned. If that is not mentioned, if it is only mentioned your address, he is not even there in the picture, but he has received the goods, then there is an issue. If
Yeah, he gives me an invoice as if he is giving me the product from Rajasthan.
He's giving it from Rajasthan.
Yeah, subsequently. After 2
No,
days.
sir. So I think what we can do is we'll take this case of yours offline, because I'd probably want to see what is the invoice that is raised and what is the e-way bill that is raised, and I can probably tell you as to what the position should be. Ideally, there is in GST there is an option that it can be a bill to ship to option. If I am buying the product, it need not come to me. It can very well go to my own branch sitting in some other state, or my own customer, or my own job worker. There is no restriction to that. As long as the address is mentioned, ITC will be allowed to me as if that product came to me itself. So that there is no restriction there. But if that is not mentioned, still the product is being sent to Rajasthan, or and it's not getting caught. So just because it doesn't get caught doesn't make it right. So this, I think your scenario alone, we can connect offline. We'll look into the details and definitely let you know as to whether the procedure being followed is right or not.
Okay, thank you very much. Thanks a lot.
Sure, sir.
Bye.